You're listening to another episode of the Young Investors Podcast, so sit back and relax as myself, Brandon, and my buddy Hamish discuss the latest in the world of finance and stock market investing. Now, a quick reminder before we get into the podcast is that nothing in this podcast should be taken on as personal financial advice. If you're ever unsure about your finances or investing and you need some help, make sure you reach out to a qualified financial advisor. But with all that said, let's get into another episode of the Young Investors Podcast. Okay, let's go. Welcome back, everyone. Back for another week, Young Investors Podcast, and the coronavirus continues. However, markets are going up a lot at the moment. Hamish, what's going on? Why are the markets going up? Please give us your full rationale and include examples, please.
Wow, way to put me on the spot at the start. Welcome in, guys. It has been. It's been going up. What is it? Up about 15% for the Australian market, up 20% from its bottom.
Yeah.
So obviously, we know now that it's not going to go down again. Obviously,
exactly. I mean, of course.
It couldn't. It couldn't happen.
But it kind of brings me back to what Ted was saying just the other week. How he was mentioning that some of the best, periods to be an investor are just coming out of, after a market has just tanked horribly. I think he was saying like some of the best day gains in the stock market come very, very close to the worst days as well. So
yeah, well, I saw an article earlier in the week. The Dow Jones had its best day in 80 years or something.
Really? There you go. Yeah,
which is hilarious.
From February 20th to March 23rd, the ASX lost 36%. And then from the 23rd of March to now, it's gained 15.68%. So it's pretty crazy. Imagine it, obviously you can't time it, but imagine if you got in right at the bottom and even now you're just sitting on this plus 15%. That'd be nice.
Yeah, definitely. It's so easy to get caught up in the day to day when it's so much more exciting than it was last year. Yeah. Seeing a down 8% day, down 10% day, up 6% day.
It's pretty crazy just how little volatility there was, and all of a sudden now it's just it's like totally normal to see like plus or minus 3, 4, 5, 6, 7% in a day, whereas like looking last year and that was just not happening. Certainly not negative 3, 4, 5, 6%.
Yeah, you could actually go back and listen to our podcast from last year, because at the start of each podcast last year, we did the indices, and you could just listen to the first 5 minutes, and we're always just like, 0.5%, 0.5%.
Yeah,
nothing too exciting happening. Let's move on to something more exciting. Yeah. It's crazy.
Yeah, and now this, but no, it is interesting to watch. It's probably the biggest fluctuation in the market since I've been investing. So I love watching it, just seeing what happens and seeing what people want to talk about and, what the news thinks of it, even though I obviously don't really trust any of that stuff. But it's just interesting to see like what the media comes out with.
Yeah, definitely. Well, if you're a value investor or even just a long-term investor, then more volatility is what you want to see, because you want people to be selling stocks emotionally so that you can pick them up rationally, and to people to be, in the other direction as well. If you're someone who tries to sell stocks when they get overvalued as well, volatility is good for the value investor. We want an irrational market. We don't want a market that's efficient. If the market's efficient, we don't have too much of a job here picking individual companies. Boring. Yeah.
Our opportunities are few and far between if the market's being pretty rational.
Definitely. Yeah.
All right. Should we get to today's sponsor?
Yes. So today's sponsor is Sharesight. So Sharesight is an application that I've personally been using for the past few years in order to track the performance of my stock portfolio. And it is really fantastic for keeping track of all of the different types of gains that you get when you're an investor. So there's obviously capital gains when the stock price goes up. There's dividends that you receive. If you have dividend reinvestment plans, it will do all of the calculations for you. So that's probably been one of the most valuable ones, particularly if you're in index funds. A lot of them have dividend reinvestment plans. And a lot of the time it's almost impossible to figure out for yourself how much you're benefiting from those shares that have been reinvested. So it does all of those.
It's hard to track.
It is. It's probably one of the more difficult ones to track. Alongside currency, it also tracks your currency. So if you're in Australia, you're buying international shares, or you're anywhere else buying international shares, or even if you just hold foreign currencies, then being able to calculate the exact return that you've made on your money in all areas is super important. It's super important not to just neglect the currency exchange or some of the other impacts. But then really the main reason why I use it and why it's so valuable is that when it comes to tax time. So Sharesight generates up to 10 different reports. So from capital gains to dividend income to your performance for unrealized and realized gains. So there's 10 different reports that can be used at tax time to give to your accountant or just to use yourself in order to easily figure out how much you owe in terms of capital gains, dividend income, and more. And it does work internationally, but particularly if you're in Australia or New Zealand, it works perfectly. So, and why we're talking about this? Well, you can try Sharesight for free by heading over to sharesight.com/young investors. That's site spelled SIGHT. So sharesight.com/young investors. And if you use that link, you can also get 2 free months when you sign up for a yearly subscription. So
thanks, Sharesight.
Go out and check it out. Try it out.
Check it out. Hey, did you happen to see all the comments on last week's podcast on YouTube?
No, I didn't.
There are so many people that follow us firstly on Spotify.
Yes, I can't believe I forgot. Yeah, I got a message from a couple on Instagram as well, people reaching out. So I was right. There are people.
There's got to be at least like 10 comments maybe. I haven't got it up now, but I think I read at least like 10 comments saying, yeah, I found you guys on Spotify, and then after that they came over and started watching us on YouTube, which is just awesome.
That's actually really exciting because when we were starting the podcast, I was really worried that I personally had never found a podcast just by browsing around on Spotify or anything. I'd always found them on YouTube, or someone had kind of suggested it to me. Just because YouTube is so easy to search for things you want, whereas Spotify, I find it a little bit more challenging, or maybe I'm just not, I don't know what to search in order to find things. But it's great news that we're able to generate an audience in both locations, not just sort of the same audience coming across from our YouTube.
To be honest, I did think that the podcast was just going to be people that just want more of our content that just follow us on YouTube. So I don't know. I'm kind of happy that, some of you guys just like listening to the podcast because it's a podcast kind of thing. Just not because, I don't know, we're from YouTube or something. I don't know. Does that make sense?
Yeah, anyway. No, I think I know what you mean. Yeah.
Yeah. But no, that's awesome. Anyway, let's get on to some news topics for today.
Yes.
Did you see that that Boris Johnson is in intensive care?
Yeah. Yeah.
Did you see? That's crazy.
Yeah. I mean, it is crazy, but it's also just a matter of, just because of the sheer number of cases there's been, there's going to be some famous, I guess, high status,
more notable names.
That's the word I'm looking for. More notable people, getting the illness. But particularly because he's in intensive care, which is, fairly serious.
Fairly serious.
Yeah.
You don't go to intensive care unless you need to.
Yeah, definitely.
It costs a lot of money each day. Not that I'm saying that Boris Johnson doesn't have the money to pay for it. But yeah, it costs a lot of money and resources for an intensive care bed to be occupied. So you don't go to intensive care unless you have to. So yeah, pretty crazy. So he's caught the COVID. Also looking up how many other famous people had caught the corona, but not too many that I knew. The only ones I knew out of the list was Tom Hanks, Idris Elba, and Prince Charles. I didn't even know that Prince Charles had the coronavirus. It's pretty crazy. Did you know that? Did you hear that?
No, I don't. I don't know. I don't really keep up with that kind of news too much.
No, me neither.
It's a bit of a
celebrity news is like the last thing on my priority his list.
Tom Hanks has the flu. Woo.
Yeah. That one I did hear about because obviously he got it on the Gold Coast. But I always wonder how those like magazines that you see in the shopping centers that are just like complete gossip, like, oh my God, Meghan Markle in a swimsuit. Just like, how do people buy that stuff? I don't understand.
Yeah.
Because it's just all it's all just gossip. Like,
yeah, that's not my lane at all.
Yeah, barely any of it is grounded in facts. It's just someone with an opinion that's just like, anyway.
Yeah.
Oh dear. But anyway, hope you get better soon, Boris.
Yeah, hope so. I hope everyone gets better soon. Hopefully it's just...
Hopefully it goes away fairly
I know
soon.
It's going to take a long time, but hopefully it's...
I think we both know that it's not going anywhere anytime soon, but I hope that it goes away.
Yeah.
Yeah. Anyway, moving on from that.
Yeah, one thing that I did see coming up that's sort of related, that's going to be very interesting in relation to all of this coronavirus stuff is that earnings season in the US will be kicking off next week. So
yes,
and why is this sort of important? Well, it'll be the first numbers that we're actually seeing out of companies, official numbers about how impacted these companies are by the global shutdown. So of course, for some businesses that have been severely impacted, they're making announcements on a week by week basis at the moment. I think I saw in your video you spoke about Delta saying they were losing 60 million in cash a day or something like that. So we've kind of got some of those numbers floating around, but we don't have official financial statements. Here's how much debt they owe. Here's how much money they just lost in 3 months, kind of thing. So I'm actually really excited to see which companies are holding up better than others. And just to see, I guess, if any companies are going to continue to provide guidance as well, because a lot of them have just withdrawn it. But
yeah, that's true. They've just gotten rid of it completely. Well, I mean, that's kind of fair enough, because if you legitimately have no idea how long this is going to go on for, then how can you even try and provide like an even slightly accurate guidance?
Yeah. But the funny thing about guidance is that after all this happens, they go, yeah, we can't predict the next 12 months. Well, I don't know if you could have predicted the next 12 months in a lot of times in the past. Yeah. I mean, I know for sure companies last year, before all of this happened, like Q4 or Q1, whichever one it was, a lot of them would have been guiding forward this year. So... I mean, it just... I
think they guide as if nothing's going to go wrong.
Yeah, exactly. And it's...
But of course, they don't know if something's going to go wrong.
Yeah, it's like we'll guide, but as soon as we're wrong dramatically, we'll just withdraw it. And we'll just say, we can't guide this period. Sorry.
I don't put a huge amount of stock in guidance.
I put zero stock in guidance.
Yeah. I mean, if I trust the management team, then I will believe, like, if like Elon Musk comes out and says, yeah, next year we should have the capacity to make X amount of Model 3 vehicles based on, so we anticipate that we'll ramp up to this amount. Like, I believe that. It gives me an insight into what the management is actually thinking that the business will be able to achieve. But I don't place a big bet based on whether or not they will be able to achieve that guidance 100%. Like, I like to pay attention in seeing what the management actually thinks the company will be able to do. But I'm not going and betting the house on whether Tesla can make 500,000 Model 3s next year or whatever the numbers are.
No, that's actually an excellent point, because guidance, and particularly 3-year guidance or 5-year guidance, when management teams come up with a long-term or a medium-term plan, that kind of guidance can be very useful, because we can look back over past periods and see if the management team has been hitting those goals, or whether they just say, yeah, we're going to do 1 million in sales by 2015. And then you look at the 2015 presentations and it's just nowhere to be seen. It's as if they've just forgotten that action kind of existed, or that goal existed. That's kind of funny to see when a management team kind of just puts goals out there, and then when they don't hit them, they just make new goals.
Forget about it. Yeah.
That's always a curious thing to see.
Or when they're coming out now and saying like, oh, we think the next 5 years we're going to grow at like 20-30% annually, and then you actually look at their growth or what they were predicting over the last 5 years, and they were predicting like 50% annual growth, and they achieved like 10% annual growth. And you're like, okay, not going to trust you anymore.
Yeah. And that CEO gets booted out, new CEO comes in. Now, right, we're going to return return $20 billion to shareholders.
Yeah, great. Yeah, and at the same time, we're gonna completely revamp our business. Yeah, it's just, anyway.
Yeah.
Oh, guidance, good old God. But yeah, going back to the idea of earnings season, I'm really, I can't wait. Like, I really want to know what these companies, what companies are seriously affected by the global situation. I can say it. It's a podcast. The coronavirus. Yeah. I'm not on YouTube. Well, I guess I am, but our YouTube podcasts aren't monetized anyway. But no, I'm seriously like, there are going to be so many businesses that are directly impacted by the coronavirus, like the cruise lines or the airlines, but there are plenty of businesses, well, most businesses, in fact, are going to be indirectly impacted. Like, you might say a Facebook won't be directly impacted, but they might be indirectly impacted by the fact that companies are saving money right now, not spending a lot of money on advertising campaigns. So all that sort of stuff, that's the stuff I'm really interested to see, is how big of a toll has this business shutdown had on all these different companies? Yeah,
I was just about to bring that up. In terms of Facebook and Google, so do you reckon that they'll see a significant drop-off in their revenues? Just because,
well, here's my reasoning, right? I look at my own YouTube channel and the revenue, and while this has been a great patch for us to make content about the stock market because so many people are searching it, when I actually look at each video, I'm actually earning quite a considerable amount less per video in advertising revenue. And because like YouTube hasn't changed its policies, so they haven't changed the cut that they're giving to YouTubers and the cut that they're keeping from themselves. So if I'm getting heaps more views, but my revenue per video is decreasing, then I think there has to be, like, in some instances, I've been talking to a couple of different people and they're saying that their revenue is down by maybe 20, 30, 40%. Right. So I'm like, maybe that could be the little inside knowledge that tells us that maybe YouTube might experience a decrease, or Google's YouTube revenue might go down by 20, 30%. Maybe, we might see the same out of Facebook. Facebook revenue might go down 20, 30% in the short term. Yeah. So that's kind of a real life example that I kind of make an inference about, but yeah. Yeah, no, I mean, I certainly think that if YouTube's revenue is going to be down, advertising revenue, then Facebook's will probably be as well. I think they won't move in different directions. I think they'll probably move in the same direction. But that's exactly it, right? It's if we as YouTubers are making more money during this period, then YouTube would also be making more money because we take a 55% cut or something like that. Yeah, I think so. From the total revenue pool. So that's really the question. And I know that a lot of, I guess, in the finance space, revenue has gone up, but whether that's the case across the board, I don't know. It'll be interesting to see. I wonder if a lot more smaller businesses that are not debt, that don't have a lot of debt, I wonder if they will be advertising more because of how many people are at home and buying things online instead of going into stores. That's something that I would like to see. It'll be something that I'll be interested to see if that's a factor and whether anyone talks about that. But yeah, I'm not sure. I presume that their revenues would go down somewhat, but definitely by how much, I don't know. I would like to think that they wouldn't be impacted that much, but yeah. Because you can make the argument the other way, as you kind of alluded to just there, is that everyone is currently staying home and consuming content and, spending hours and hours and hours a day on the internet. So isn't this a great time to be advertising? Like, you might just, by the fact that everyone's staying home, have so much more attention going to these social platforms that maybe you do want to get your ads on there right now. Yeah. And potentially even more if some of the bigger companies are actually, feeling the financial hurt and struggling a little bit and reducing their ad spend. Maybe that's pushing downward pressure on the ad prices and you can come in and get like underpriced attention or something. Yeah. And the more people who are watching videos and scrolling through a Facebook newsfeed, the more real estate that there is for ads, which means there's more supply. So that would also put downward pressure on the cost of ads. So maybe ad costs will go down. Other people will come in and buy some advertising space at a lower cost. And I mean, we'll just have to see what happens, of course. We'll put Young Investors podcast slogan. There it is again. We'll put a sticky tab. We'll come back and talk about Facebook and Google earnings when they come out and see exactly what happened to the ad revenue.
Yeah. And I mean, in terms of when companies will be reporting, while earnings season does start next week, I had a quick glance and there wasn't anyone that particularly stood out to me personally. There was a few banks reporting. I think Airbus was reporting, which might be an interesting one. But all of the big tech names that we usually cover or any of the other businesses we follow, they report in a couple of weeks' time.
It'd be like 2 or 3 weeks, wouldn't it?
Yeah, over the next month and a month and a half. So,
I love this time.
Yeah, I do too, because we always have so much to talk about on the podcast. It's fantastic.
And you're going to see as well massive swings in stock prices. That's the one thing I'm predicting. I can't predict whether it'll be up or down, but I think one thing's for certain is we will see massive swings in stock prices.
Yeah, definitely.
I don't know. Oh, I can't. Yeah, I'm looking forward to it. Anyway, all right, let's move on. Let's talk about the cruise stocks a little bit.
Yes.
I just made a video on them. In fact, I want to talk about Carnival because it's interesting. Carnival's been going up pretty strongly over the last couple of days. But get this. So after they fell, this is the I'm sure we'll get into this more, but this is the problem with not having enough short-term assets on your balance sheet to pad your way through a big crisis like this. After Carnival falls 90%, they raise $6.25 billion in capital. So they priced $4 billion in bonds maturing in 2023 with a yield at par value of 11.5%. 11.5%.
That's horrible. That's almost like a credit card. Credit cards were like 25% or something.
They may as well. Just go get a credit card.
Oh my goodness.
Put it on the company card.
We've taken out 64,000 credit cards to pay our...
We've maxed out 1 million credit cards. Oh dear. But anyway, so Carnival also used their boats, their ships as collateral to attract the bond investors at the time. They also raised $1.75 billion in convertible notes with a 5.75% coupon. And then outside of the bond issues, Carnival issued new stock to raise $500 million, which is less than the $1.25 billion it was targeting. Ooh. But yeah, I mean, I don't even know how to look at this, because it's probably good that they didn't raise too much stock, because if you're an investor and imagine this share price has fallen 90%, and after it falls 90%, that's the time that you decide to raise capital and sell stock. You have to raise stock for literally 90% less, or you have to sell stock for 90% less than what it was worth like only a few months ago.
Yeah.
Oh, ouch. That dilutes shares very quickly. I feel sorry for shareholders a little bit.
Yeah, I mean, I would too. And I mean, this kind of event is obviously way more dramatic than anyone could have possibly predicted. But there are still companies who had good balance sheets in anticipation for something horrible to happen. And when you don't have a plan for how you're going to act if I should say, because it's always inevitable that something like this happens, then you have to do exactly that. You have to raise equity, or you have to get more debt at horrible interest rates. Shareholders are not going to be happy about this. The thing that I was thinking about was that it's one thing for the stock price to have fallen 90%, but if they consistently raise equity, which they could just to keep themselves afloat, the stock price might not go down much further, but the value of each shares will be diluted severely to the point where, I mean, for example, if they doubled the number of shares outstanding in order to generate a few $1 billion, then that would result in another 50% cut. It's the equivalent of the stock price falling 50% for the individual investor.
That's interesting, because then you would be doubling the amount of outstanding shares. So that would mean that the shares are worth so much less. So you would anticipate them to fall. But I think that if they've already fallen 90%, would they fall further if they raise that amount of money and it basically guarantees that they won't go bankrupt? Would that kind of put investors at ease and the share price wouldn't fall that far? I have no idea, but
Yeah.
in fact, I still reckon that it would fall. If you diluted really, really hard and it meant that you weren't going bankrupt, but you were still really diluting the shares, I reckon they'd still go down.
Yeah, definitely. One other thing I did want to say on this topic is you mentioned that Carnival's using some of its ships as collateral to attract bond investors, which essentially, for those who don't know what that means, if Carnival can't pay back those bonds, then the bond investors will just take the ships and they'll sell those in order to get their money back. And that's interesting because I saw a very curious comment of someone talking about Carnival saying that the bond investors wouldn't let Carnival go bankrupt because then they wouldn't get their money back. But that's the wrong way to think about it, because Carnival might not be able to pay with cash, but they still have assets in their ships that are worth billions of dollars, I would presume.
Right,
Which means that the bond investors aren't going to just be like, oh, you don't have to pay, we'll wait until you get cash flow positive again. They'll just take the ships and sell them to another cruise company and get their money immediately, even if they have to sell the ships for less than they're actually worth on the balance sheet.
They'll get their money.
They'll get their money one way or another. It's the fact that it's a type of company where most of their assets are in assets that they can't turn into cash easily. They can't turn a ship into cash easily in order to pay for these, pay these debtors and that sort of thing. So
that's the only thing I was thinking with this whole industry being destroyed right now. If they went bankrupt, and I mean, you've built a cruise boat. Yes, you can strip the interior, but at the end of the day, you're still left with a cruise boat. So if these companies are all in horrible financial situations, who buys that boat?
Yeah, some big rich investor who goes, I'll buy your company for 10 cents on the dollar, or 1 cent on the dollar. You can keep.
But that's the thing.
Yeah.
I'm thinking that if, say, what is it, Ovation of the Seas or something, if that boat, or I think it's even the class higher than that, I don't know, but if that boat costs just over $1 billion to build, and all of these companies are raising money and struggling to keep their head above water. Do you like that one? That was a good one.
Horrible.
Yeah, that was pretty bad. But if they are struggling like that, are they even in a financial position where they would buy that boat, or would the boat just be sold for just absolute pennies? I don't know.
Yeah, I don't know. Depends if there's someone there to buy it, I guess. I mean, if Carnival goes down, but Royal Caribbean's okay, and they're like, oh, that's a nice ship. We'll take that for 200 million.
Yeah, maybe that's the thing. They just have to sell it for so much less that it's like it's cheap for the other company. Anyway,
yeah.
Who knows? But yeah, I released a video on it today. I'm joining the other 50 billion videos on the cruise line stocks.
Yeah,
I tried to be a little bit more objective than the rest of them. Oh man, some of the. Oh my gosh, do I even want to start this rant? Some of the other cruise stock videos I've been seeing, holy moly.
No, we want this rant. I saw you posted something on Instagram, and there was someone's video called like time to go all in on Carnival, and you made a comment saying it's time to run for the hills when you see a video.
When a video title is it's time to go all in on Carnival just. Like I said it in my Instagram post, I know it goes without saying. I know you guys are all very, very smart people, but far out. If you see that, do not click on that video.
Yeah.
Holy moly. I promise you, I speak for Hamish as well. I'm sure I speak for you. We promise we will not make videos where it's titled, you need to invest your entire bankroll in this stock right now.
Get a second mortgage on your house.
Yeah.
Go.
Mortgage the house. This guy on the internet that's got 10 subscribers and is trying to, 15 views on his video just said, I need to go all in on Carnival stock right now.
Not that this excuses it, but that's really it, right? It's become that point where it's very competitive to start up a channel in this area that some people just go way off the top to try and get clicks.
Yeah. They have to get there. They're just trying desperately. Yeah.
But it doesn't do too much for your credibility.
It's reputation.
Yeah.
I mean, there are some good. I'm having a look now. There's some good ones. CCL stock analysis. Is Carnival stock a good buy today? That one I don't mind too much. CCL stock chart technical analysis. Yeah, that one's fine. Yeah. Then there's ones like, I made a huge CCL stock investment.
Wonder who that was.
Yeah, dump all of your money into Carnival.
Sell your
Sven's
wife.
Got one. I need to watch this.
Who posted one?
Sven. He's usually pretty objective.
He's very objective. Yeah.
Yeah. He's smart, but I just hate that you're right. There's just so many clickbait videos at the moment where you click on them and they're like, oh my gosh, let me tell you about this unbelievable thing that's happened. It was truly remarkable. I cannot believe it. You guys will not believe what I am seeing right here in front of me today. Oh my gosh, I can't believe it. Carnival, oh my gosh, you won't believe. It's like,
get to the point.
But they're doing it completely on purpose. It's like, got to hit that 10 minute mark. Must hit that 10 minute mark.
Must be able to put 7 ads in my video.
7 ads in a 10-minute video. Anyway, golly gosh, I'm going to lose friends if I keep ranting too much.
No, this is a safe place for rants, all right?
Safe place for ranting.
I'm not going to stop you. You're not going to stop me, so.
That's true. But anyway.
Actually, getting back on track to talking about struggling companies sort of raising debt or raising equity. There was another company closer to home in Australia that recently had to raise equity. And this is a good sort of, I guess, case study or example of how raising equity can destroy value for shareholders in a way that a lot of people might not recognize. So Kathmandu, very successful Australian retailer. They actually recently purchased Rip Curl as well. So 2 very successful brands in Australia and globally as well. So Kathmandu, recently they did raise $154 million while it struggled with most of its stores closed across Australia and New Zealand. So in Australia at the moment, I mean, most retail is shut down. There's some open for essential things, but for the most part, you can't go out and go shopping. So a lot of these stores are closed, and they actually planned to raise $205 million. So that's what they were aiming for. They ended up getting 154. But the kicker is that they raised it at 50 cents per share. So, I mean...
what was their share before?
Yes. So 2 months ago, the stock was trading at $2.50. So that's a 75% drop in the stock price, which is now at 60 cents because they're raising at 50 cents. It's pretty normal for the stock to hover around the price that they're raising at. So if you thought that a 75% drop was bad enough, so if you held the stock 2 months ago, you suffered a 75% drop in 2 weeks. Then on top of that, they raised capital, which what they did is they raised equity. And that meant that the number of shares that the company was split up into went from 300 million to 600 million. They just announced this in the last couple of days. Doubled. So it's pretty much more or less doubled, which means that you've lost as an investor another 50% in value.
Crazy.
Your 1 share out of 10, which was 10% before, obviously that's very simplistic, but your 1 out of 10 went to 1 out of 20. Your 10% equity stake went to 5%. After a 75% drop in the stock price. So that's just an example of what can happen when companies get desperate. And obviously doubling the number of shares outstanding it's an extreme example. That's not the norm. Sometimes you might see a 10% increase and that's quite big. I think Tesla did a couple that was maybe 1 or 2% increases or something relatively small. But when it does happen at a big scale because they're desperate, because they need money, it can really hurt investors, and it's something you need to keep your eye out for. It's another reason why it's not just a matter of investing in companies with big brands. They need to have enough cash around so they don't need to dilute you. If they need to dilute you, then it's going to hurt, and you won't know how much it's going to hurt because you don't know how bad the equity raise is really going to be.
And this is why we've been looking at the things like trying to predict, okay, if the companies we're analyzing, if their cash flows go negative or just go to zero for a little while, then turn to the balance sheet, have a look at that cash cushion, have a look at what's lying around, what are their obligations, what do they have to pay, what have they got in the bank, and you start looking at those numbers and you can kind of get a better picture of how quickly their cash position will whittle down. Because if you're a big company, like, you can have access to the debts and that sort of. So that's what we saw with Carnival. Obviously, they just started. They just made their bonds. But yeah, you're right. If like you're either taking on debt or you're raising equity, and it's exactly what we're talking about just before with Carnival. If you start raising equity, then it's going to really dilute your shares. If they're in serious need of money, then that can dilute your shares very, very quickly. So you just have to be, just really focus on how well your companies that you're analyzing could potentially get through a sustained period, couple of quarters of basically zero cash flow, because you don't want to be stuck investing in a company and then it all of a sudden comes out and it does exactly what Kathmandu has done, and it says, we're going to go bankrupt unless we take these drastic measures. We're going to double the amount of shares outstanding that we've got to raise some more money to keep us afloat. Because exactly right, if you owned 10%, now you own 5%. So just be careful.
And I mean, it's also another reason why I try and look for companies that, even in tough periods, they don't go cash flow negative. So even when they're not making much money, they're able to mitigate some of the costs to a point where, at the worst, they're just making no money. They're not losing money on the balance sheet. That's also another thing that you can look out for to avoid companies that could quickly get into a lot of trouble, because there's some clear industries. I mean, the airlines is a great example of this at the moment, where if their sales dry up, they have all of these costs,
many fixed costs
that they can't reduce. So to the point where if they're not making sales, they're actually losing a substantial amount of money every single day until they get back on track. That's very different to another kind of business that might really not have really any debt. For example, they have no interest payments that are due. They might not have any long-term contracts or something like that. I don't know. There'd be different types of fixed costs that businesses might not have to have. And as a result, if their sales dry up, they're just not making any money for a while.
Yeah, it's just zero. Yeah.
They're just kind of hovering along. And those kind of businesses always survive out the other side, because they don't have to make a debt payment in 6 months. They don't have all these contracts that are due. They just kind of accept that their business kind of sucks for 6 months, and then on the other side, when customers come back, they return to normal. So
yeah, exactly. Yeah. They're not at risk of going bankrupt because they're not hemorrhaging money. They're just stagnant. They've just gone on holidays for 6 months.
Just take a break.
It's just pause time for a while, basically. Hey, we got to cover this next news story a little bit as well, because I just saw today that Bernie Sanders, he's exited the race to become the next president of the United States. Oh, so it's now Joe Biden versus versus Trump. So there we go. November the 3rd, I believe, is the election. So yeah, this is it. It's Biden versus Trump.
Yeah.
Who do you reckon will win?
Yeah, I was going to say.
Let's take a prediction now.
I don't have a horse in this race. I'm not politically affiliated either side, or I don't really care. But in terms of who I think has the best chance of winning, if it was Bernie Sanders versus Trump, I would have said Trump was almost guaranteed. I think, yes, I would have said that he had a very high chance. I think Joe Biden has more of a chance than Bernie Sanders. But considering they're almost, in many ways, they're the same person. Obviously, they're politically, they differ a little bit, but I think Trump will stay on for another 4 years.
Okay.
Yeah.
Wow, big call. No, I reckon Biden's got it. I reckon he'll do it. I reckon he will. Yeah.
Maybe.
I don't know, but you're right. That flippin' Trump marketing machine, those Trump rallies, it's a cult. It's a bloody cult. Oh dear. But I guess like all of these candidates, it's kind of a bit cultish, isn't it? Like Sanders had his cult and Biden's got his cult.
Yeah. The thing is, whenever there's trouble in the economy or in some other way, usually there's a change it flips the other way because people just want change. They want something better. They think that, even though this, obviously the coronavirus isn't Donald Trump's fault, people like to think that the people in power are in control of all of these things, and therefore we should just flip it over and try someone else when something's going wrong. That seems to tend to be the trend. So we'll see what happens, but I think Trump will. That's my bet.
There we go. We don't normally disagree on stuff, but here's one of them. Yeah, I don't know. Trump definitely has the whole marketing machine going, but I just think at the end of the day, when you take like a population of an entire country like as big as America, and you just stand, these two people next to each other and kind of what they stand for and how they act. I don't know. I feel like Biden's got it, but we'll have to wait and see.
We will. This is a long wait and see. This is like a 6-month wait and see.
This is quite a wait and see. I can promise you guys that we will definitely cover this topic when the result happens.
That is true. Yeah. Definitely.
All right, next up, I wanted to talk about the JobKeeper scheme. A lot of you guys have probably been hearing about the $130 billion JobKeeper scheme because probably a lot of you are eligible for it. So I thought I'd talk about it because it actually just got passed with support of both sides of Parliament. So it's actually expected to be accessed by 6 million Australian workers. So essentially what the JobKeeper scheme is offering is it's offering businesses affected by COVID-19, they can receive $1,500 per employee per fortnight. And then the businesses have to pass that payment onto their staff. And this system is, at the moment anyway, what was passed is that it's going to continue for 6 months. And as of Wednesday morning, 750,000 businesses has signed up, and that number continues to grow.
Whoa.
So it's pretty interesting because essentially the way I understand it is if you're an employee that is earning more than $1,500 from your employer, then you get like nothing. But if you are an employee that's earning any amount under $1,500, then your employer has to give you $1,500.
Right. Okay.
So it's like if before you got stood down, say, if you were earning like, I don't know, $500 a fortnight, or if you were earning $1,400 a fortnight, doesn't matter. If you get stood down, then I think everyone just gets $1,500.
Yeah, it's like a flat payment to all employees, right?
Yeah, which is great. Like if you, it's kind of better if you earn less, so you get more of an advantage, I guess. But anyway, if you can call it that, I don't think there's any real advantage if you're being kept at home and not being paid and not able to work. But
yeah.
Anyway, I wanted to talk about eligibility because I'd encourage everyone to just check whether you're eligible because from what I understand, it doesn't seem like the eligibility criteria is too hard to hit. So eligibility, you're currently employed or were employed by your work at March the 1st, 2020. This includes anyone that has been stood down or rehired since then. Then the next point is you're either a full-time or part-time employee or a casual worker who has been employed regularly with the same employer for more than a year. The next one, you need to be, either an Australian citizen, someone with a permanent visa, a protected special category visa holder, a non-protected special category visa holder, blah, 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 who's been residing continually in Australia for 10 years or more. And then you can only receive the payment from one employer. That's the last note. Right. But that's basically all they say in terms of eligibility criteria. So
yeah.
Definitely check if you are entitled to receive this payment. So
yeah, it's obviously very broad. There's not many requirements at all. So that's obvious. That's a good thing. But a lot of people, I'm sure there's tons of people who are not even sure that they would be eligible for something like this. Just because whenever I see something like this on the news, in particular related to business, because of my business, I usually just think, I can't get that. Like that's probably for somebody else. But it's I guess it's good to talk about because it's this is one that is going to be relevant to a fair amount of people. So
and I'd probably say as well, probably err on the side of thinking that you are eligible because for instance, I was wondering whether I was eligible, so I called the ATO the other day just to have a chat to him to discuss my current situation, say, hey, am I eligible for this payment? And the guy literally, he was a super nice guy, but he said, look, we've got very little information on this at the moment. I've basically just got a fact sheet that we're working off of at the moment because, you know, the laws haven't been passed and blah, blah, blah. So I was just asking him, you know, in my situation, do you think I'm eligible? And he was like, look, I probably don't have enough information to be able to give you a definitive yes or no. So I think if the tax office can't even tell you yes or no, then you should probably err on the side of just considering yourself eligible until there are harder facts to prove you otherwise. But I don't know.
Yeah, definitely. No.
Yeah. Anyway, we'll leave that there. More of a PSA than anything. But what should we talk about next? We should finish off with this one. I wanted to talk about this one. Coronavirus data shows job advertisements in freefall. Who would have thought of that? But there's a couple of interesting stats here. So first of all, the article reads, the coronavirus pandemic has led advertisements for new jobs to plunge 65% compared with the same time last year. Data from job ads website Seek has showed. The falls were greatest in New South Wales, which was down 72%, and then next in Victoria, which was down 67%. So obviously, like, this is almost a non-story because obviously with the situation, the amount of employers seeking new workers is not going to be very high.
Yeah, but I mean, we can see which industries or which areas, which types of jobs have been hit the hardest, I guess, right?
Exactly, yeah. And there is a really good, this is on the ABC website, so you can go, there's a really good graph. It says sport and recreation has been definitely hit the hardest. They've got a 98% reduction in job listings. Advertising, arts and media. So that's interesting. That might relate back to the YouTube, Facebook discussion we were having before, down 86%. Administration, office support, down 85%. Hospitality and tourism, down 84%. Sales, down 84%. Retail and consumer products, down 80%. And the list goes on.
Yeah. A couple that we've got down the bottom, I guess the least hit, would these be, are these still the worst?
No, this is still the worst.
Yeah,
this graph continues to go. Yeah, it just keeps going and going. But what's interesting on the flip side is that Kendra Banks, who runs Seek in Australia and New Zealand, has said that even though job ads fell across all industries nationally, there was an urgent demand for both skilled and non-skilled workers in a small number of specific industries and roles. So some of the most in demand, well, you could probably guess this as well, but some of the most in demand skilled and non-skilled workers were in healthcare, so nurses, aged care workers, general medical workers, psychologists, counsellors, and so on. In some aspects of retail, so those that are critically involved in the supply chain, you know, such as shelf stackers and delivery drivers and supply chain managers. There's some in manufacturing, again related to keeping up with demand of household staples. Family support, customer support, some call center operators are in high demand at the moment, some digital specialists with a lot of people working from home. There's a lot of IT support
That's true.
being needed. But it's kind of interesting seeing, yes, it's an event, and on the whole, it's a very negative event, a lot of people being stood down for a period of time. But it's interesting seeing that it still does cause an uptick in demand for some particular industries or areas.
Yeah, I mean, it is interesting because it's not as if it's just a decrease across the board in the need for workers. It's kind of a decrease across the board and then also a shift into some certain essential services that are still running through all of this. Yeah. So, I mean, it is interesting to see.
Yeah. I'm an unskilled nurse. I need a job. I've got no qualifications, but I'll call myself an unskilled nurse. You're hired. Go and tend to that patient over there.
Go do it. Good job, Brandon. When the podcast falls out, when it no longer works for us, we'll both become nurses.
I could just go back to being a physio, but you know,
nah,
I am qualified.
Scrap that.
Physio. No, I'm going to be an unskilled nurse.
Yeah, call center. Sure. That's where I see you.
Yeah. Gee, thanks, mate. I appreciate that. Oh man.
All right, we should do some Q&A. because
We should.
I've been saying for a couple of weeks now that we don't leave enough time for Q&A because we always just get caught up in our stories.
And then we get a backlog too. We need to do like a speed round of Q&A.
We do. Yeah. At some point we'll do a... Yeah.
We like to give good answers to our Q&A to the questions that are asked. So that's why we never get through like 15 questions. We always end up doing like 2 or 3 or something like that.
All right.
All right, here we go. First question. Let's talk about this one. How do you calculate fair value or a margin of safety when buying an ETF or listed investment company? Is this something that you do?
Yeah. So no, it's not something I do. And the reason why is because when I'm calculating the fair value of a business, what I'm doing is I'm coming up with an estimate of the future cash flows of that business. So following that rationale, if I was to do that to an ETF with 300 businesses in it, I would need to be coming up with an estimate of how much cash those 300 businesses could produce in the future to get to a fair value. And that's something I don't think I would be capable of doing. So, and I mean, it's also not something that you would generally want to be doing if you're buying ETFs, because the idea behind an ETF is you're capturing the average. So rather than trying to time and trying to buy an ETF when it's undervalued and sell it when it's overvalued or something like that, I kind of just take the view that you should dollar cost average into an ETF or a LIC.
That's the thing. I think this question kind of blends active investing and passive investing together. But for me personally, I would only ever treat an ETF as a passive investment vehicle. So in which case it really, I know this sounds a bit weird, but it doesn't really matter about the whole intrinsic value of the ETF, because you're right. If you're trying to get a good intrinsic value of an ETF with 500 odd companies in it, then you're going to be doing calculations for a very, very long time. But yeah, exactly what you're saying. I just treat ETFs as, as a tool that are capturing the average of the market. And for me to capture the average of the market, I've got to invest in something that captures the average of the market and continue to invest in it periodically over time. So for me, fair value and margin of safety, they're not questions that I think about when I'm looking at ETFs or listed investment companies.
All right. Well, I'll pose this second question to you. So sure. What are your thoughts on investing in index funds or ETFs for emerging markets or emerging markets overseas?
More ETF questions. Emerging markets, like there's a lot of speculation, I guess, of people that have an opinion that the emerging markets are going to provide much higher rate of return into the future. And I can't say that I have any particular insight to say whether that might be true or not true, but I just probably end up saying like emerging markets are kind of like India and Taiwan and China and those kind of Asian countries, right?
Yeah, yes.
What else falls under emerging markets? I don't even know.
I mean, just
like Japan, Korea, do those guys get into emerging? Probably not.
I don't know. I think emerging is kind of the new word for developing countries, developing economies. So, yeah, I mean, India is certainly the gold standard of emerging markets, but there's a lot of smaller other markets that kind of surround it, I guess. My thoughts on this is that if I did want, I don't invest in emerging markets, but if I did want some exposure, I would probably go for some kind of world ETF where the majority of the ETF is still in developed countries and strong economies such as China, the US, Australia's a small piece, but US and China mostly. And then emerging markets would be a tiny piece of that world ETF. And if that tiny piece does really, really well, it'll become a bigger piece, and then you'll own more of it, and it'll bump up your return. But then you won't be overexposed to countries that have not yet fully developed into a full free market economy like the US or like China has in many ways. But the US is kind of like the gold standard, I guess, for a free market economy.
The economies of China and India are considered to be the largest emerging markets.
Right, so they consider China an emerging market.
Yeah.
Interesting.
The 4 largest emerging and developing economies are Brazil, Russia, India, and China.
Russia, I knew Russia was in there.
Right, there you go. So there you go. But sorry, I didn't actually answer the question. What are your thoughts on investing in index funds for emerging? To be honest, I don't really invest in these markets just because I have such a little understanding of the context of their economies and their, their governments and their rules and regulations and that sort of stuff. Like, a lot of people say, invest in China right now because, their market's been pushed down and whatever. And then I'm just like, yeah, but I don't really know how, if there are any differences as to how business works over in China. I don't understand like the big sectors and the industries that are thriving in China and that sort of stuff. So I just don't really feel comfortable in investing in some of these emerging markets just because I don't have a good enough context. Like I feel comfortable investing in Australia or in the United States because I have a fairly decent understanding of how the economies of those countries work. Obviously, I live in Australia, so we get that contextual understanding of how business operates and works over here. So it makes it a bit easier for us to invest in it. So
definitely,
that's probably my answer.
Yeah.
All right. Should we do one more question?
Yes, let's
today?
do one more. Yeah.
Trying to find
a good one.
A good one. Should we do this top one here?
Yep. Let's do it.
Okay, so this question says, how do you estimate growth for a business during the valuation process? How do you estimate growth for a business during the valuation process? And what is the maximum percentage one should give a stock in a portfolio allocation?
Yeah, well, there's no... sorry, were you going to say something?
I was just going to say, maybe we'll break down the question in two parts. So maybe how do you estimate the growth rate that you're going to use for a particular business? Are there any tricks that you use?
Yeah, well, for starters, there's no easy way there's no sort of strict calculation that you can do from numbers in the past to come up with a future growth rate. Really, it's going to be different for every business in every different industry. But really, when I'm thinking about what growth rate, I'm just coming up with what is a reasonable amount of cash that this business can produce in the future. And if I give you, this is obviously easier in simple business models compared to more complex business models. But if I give you a simple retail business, for example, there's a couple of things that drive cash flow. There's obviously how much revenue is generated in each store. There's how many stores they have globally. There's how much profit is kept and how much cash flow is kept out of that revenue at the end of the day. So those are kind of the main factors. So you can work with those to figure out where their revenues might be in the future. For example, in 10 years, will they have 500 stores instead of 300? And then how much revenue do you think each of those stores can produce? It might be able to go up a little bit because they raise prices or there's a little bit more foot traffic. What are their margins going to do? Are they going to get more efficient as they get bigger or less efficient as they get bigger? So those are kind of the questions that are going around in my head. And even that is really challenging to do, even with a business that is as simple as a retail business or a restaurant business, for example. It just gets even more challenging when you look at other kinds of businesses. But that's kind of the mindset that I'm going through for that question.
At the end of the day, it really does come down to your understanding of the business, though. What number that you put on growth into the future, and you might, there's like a kind of cheaty way that you can always go on Yahoo Finance and just look at the analysis tab and look at what all the analysts are expecting for growth. But at the end of the day, you might disagree with that based on your own research into the industry and that sort of stuff. But yeah, I like what you're saying. You just got to think about the cash flow, the cash flows that are coming out of the business, what's driving that cash flow, and have a look at those factors that are driving that growth and estimate, like what you're saying, how much are they growing their in-store sales? How much are they, growing the number of stores that they've got? Like you look at a company for Tesla, the most important thing about their cash flow is how many cars they can, make and sell. So you might look at down the line, well, how are they growing their gigafactories and their production of their vehicles in China and now in Berlin and that sort of stuff. And you've just got to do your due diligence, do your research, and kind of understand where that growth is coming from in the future. And then you can look at the past as well to give you an understanding of how well they've grown in the past, to kind of understand what your company is going to grow at in the future. But I think personally, this is one of the hardest things to really, I think it takes a long time to really end up being slightly confident in the growth rate that you want to put on your company. Would you agree with that? Or is it something that you've found gets easier for you over time as you research more companies?
Yeah, I think it does get easier. And one thing that I think I figured out at some point that makes it easier is what you said is, instead of focusing on the growth rate, instead spend a ton of time learning about the industry and its businesses, because once you have a deep understanding of a business and its industry, the growth rate kind of follows on. It's kind of a natural progression to figure out, okay, well, now I know this industry historically grows at 2% and maybe it's slowing down, or maybe there's a new sector of the industry that's going to squeeze this sector. So it really comes down to your understanding of the industry and the businesses within it and how they operate. So if you focus on that, the growth rate can sort of come from that. And then to answer the second part of this question,
second part.
What is the maximum percentage you should give to one stock in a portfolio allocation? Do you have
any rules? I don't really have any rules for this.
We might differ on this. I mean, there's a nice chart that sort of shows that within about 10 businesses in a portfolio, you can eliminate most of the unsystematic risk that is associated with individual businesses. So in other words, if you go beyond holding 10 businesses, you're really getting only small increases in the benefit of having more stocks in your portfolio. So generally at the top end, I'll have 10, but on the bottom end, which is what you're asking in this question, it probably around 5. I wouldn't be comfortable putting more than 20 or 25% into one business, just because you have to think about, if that went to zero, would I be okay with that? If I lost 25% of my portfolio, would I be okay with that? That's really the question you should be asking yourself if you're putting 20% into one business. But 5 would probably be the lowest I would go to.
Yeah. The only reason where I would hold more than, say, probably. I actually probably agree with you. More than 25% of my portfolio in one particular stock is if it was an ETF that holds a ton of other stocks in it. So it's not even just one company. You could divide that up into lots of other little chunks. But no, I agree with that. I think it makes sense, because you're right. You always got to think about what's the worst that could happen here. And if you're invested in one company that does go to zero, then if that company held 50% weight in your portfolio, then that's not a good position to be in.
And I mean, I guess one quick last thing to add is there's a difference between putting 20% of a business like Carnival that's very risky into your portfolio versus 20% into a business with no debt, lots of cash on the balance sheet, and competitive advantages, great management team, that sort of thing. So when I'm putting 20% in and I'm thinking, what's the worst case? Yes, technically the worst case is they go bankrupt, but really for me, I'm thinking the worst case is I make a really low return on that portion of my portfolio. So that's very different to I would never put 20 or 25% into something I considered speculative.
I run with Phil Town's rule for this one. If you've got a couple of speculative stocks that you want to own, then don't, cumulatively, they shouldn't take up more than 10% of your portfolio.
Yeah.
So I think that's a pretty good rule to run by, because, for some people, they might see a Carnival where, there's a potential that it goes bankrupt. But I mean, they look at risk reward and they're just like, okay, well, I want to take a bit of a stab because they could be, if they made it through, let's just say if they made it through, then there could be significant upside on the share price side of things. So if you want to have a play on a speculative business, just make sure that you keep those positions very small in your portfolio.
Definitely.
Yeah, that's kind of what I'd say.
Yeah.
Anyway, should we wrap things up?
Yeah, thanks everyone for listening.
Yeah.
And
thanks guys.
Yeah, if you're listening on Spotify or iTunes and you want to go support us on YouTube, then you can head over to the YouTube version of the podcast, which is on the Young Investors Podcast YouTube channel. Yep. And then of course we have our channels, mine, Hamish Hodder, and Brandon's Aussie Wealth Creation. And we should say one quick last thanks to our sponsor for this week, which was Sharesight. So if you want 2 months free when you sign up for a yearly subscription, or you just want to try it out for free, you can by heading over to sharesight.com/young investors. That's about it. Thanks for joining me, Brandon.
That's all right. That was good fun.
Yeah.
Thanks for having a chat. That was we got into a lot of topics today.
Yeah.
So good stuff. Good podcast. Thanks guys for listening. Remember to submit your Q&A questions for next week as well over on YouTube. And we'll talk to you guys then.
See you later, guys.